Hi, and welcome back to the Business Career College video series. In this video, we're going to look at what happens when somebody wants to leave a pension plan. Many employees will be perfectly happy to work a long time for the same employer and eventually retire with that employer having helped them to build a pension plan, which they will then use to fund their retirement income. If it's a defined benefit pension, they will have a retirement income that would have been predictable and the employer would have taken all the risk with. With a defined benefit pension, this person might have some uncertainty around that pension, but they will know that they will have a pension waiting for them when they retire. So now we're going to look at employees who don't want to go that route. Employees who say, I'm happy, I've worked here for a few years, but I'm ready to move on. And now I've got some funds accumulated in my pension. And what do I do with those? Well, you may be able to leave them. Okay, you may be able to leave them with the pension. And basically, you would just have a smaller pension than other employees who put in more time and more money as a result. But let's say that you do want out. You want to take these funds out. Okay, well, we have to look at a couple of scenarios here. The first is, how much time did you put in here? And generally, this is not universally true, but generally, once you've put in more than 2 years, then these funds are both vested, which means you own both the employee and employer contributions. So it means you own both portions, and they're also going to be locked in, which means you really can't touch them. At least not right away. Now, if you are less than 2 years, so if this is not the case, and you're there for less than 2 years, then the employee gets back what they put in. So they get their portion back, and the employer gets their portion back. There are some fairly complex tax calculations that go with that. This is where we get into what's referred to as a pension adjustment reversal, where now we're going to undo the loss of RRSP room that resulted by these employer contributions. That is something that you're going to have to be aware of if you're doing a financial planning course, but at the level of mutual funds or the life license qualification program, you're not so concerned about that. So now we know you can get this money if you've been here for more than 2 years, but we know it's going to be locked in. That is, you can't just take it and spend it. So we have to have a place where you can keep it. And this is where we get into what's called a locked-in retirement account, or sometimes you'll see this referred to as a locked-in RRSP, but generally for exam purposes we're going to see reference to a LIRA, which is what it's called in most jurisdictions. In most provinces we're going to see a LIRA here, a locked-in retirement account. And the locked-in retirement account is actually exactly the same as the RRSP from a tax perspective. It does have some important structural differences that come about because it's pension money. Notably, you can make no withdrawals from it, and that also includes no home buyer's plan and no lifelong learning plan. So you're not taking money out, and you can make no further contributions. So really, all it's doing is sitting here invested, and you have all the same investment options as you have with the RRSP. So really, all that we're doing here is investing this So this obviously begs the question, when can I take it out? Well, it's probably never going to be fully liquid. There are some exceptions to that, but it's probably never going to be fully liquid. Instead, we have to wait usually until age 55. Okay, so at the earliest of age 55, and the latest of age 71, that is, you can't wait until any later than 71. In most situations, not any earlier than age 55, although there are some exceptions to that. You can move that money into what's called a life income fund, a LIF. And what the LIF is, it's very similar to the RIF, the Registered Retirement Income Fund. What we're going to do here with the LIF now is we're going to have a mandatory withdrawal each year, just like you do with the RIF. So you're going to have a mandatory withdrawal each year. However, it's still locked in, so there is also going to be a maximum withdrawal. So you're going to have to take some money out every year, but you can't clean this thing out. Now, in many jurisdictions, not all, this is the case in Ontario, in Manitoba, in Alberta, and to a greater extent actually in Saskatchewan, when you make this move to a LIF, that is when you say, I'm going to now switch from my LIRA to my LIF, what happens here at the same time is we have a feature called pension unlocking. And as a one-time provision, except in Saskatchewan where this is much more liberal, but in Saskatchewan what you can do here is you can take up to 50% of that and put it into a RIF or an RRSP, which means those funds are unlocked. They're still going to be subject to all the same tax rules. That is, anything that we're dealing with over here, anything coming out of our LIF is going to be taxable, just like it is coming out of an RRSP. That's no different over here. The difference now is that it's unlocked, meaning that you can access that money at a greater rate. You're not subject to this maximum withdrawal. If you're curious, in Saskatchewan, you can get 100% unlocking when you do this. And both Saskatchewan and Manitoba use a plan called a PRIF, which is a prescribed registered retirement income fund. You don't have to worry about that for exam purposes at the life licensing or mutual funds level, but certainly at the financial planning level, you will have to concern yourself with that type of detail. Now, this really follows the path of flow here. That is, I'm leaving a pension, I go to a LIRA. At some point, I move from a LIRA to a LIF. I also do have the opportunity to go from a LIRA to an annuity, just as if I had really stayed in the pension the whole time. An annuity is an option as well. Generally, for exam purposes, you're going to have to equate the LIRA to the LIF, and students do sometimes get caught up in this a little bit. My suggestion is, as I showed you with the RRSP where all of our R's fit together, here with the LIRA and the LIF, all of our L's fit together. So keep that in mind, that those like letters fit together. That is, the LIRA flows to the LIF, whereas the RRSP flows to the RIF. Now, one other question that might arise here is, if I have somebody who's leaving this pension plan and they're in a defined contribution plan, then it's pretty straightforward here. We just have a dollar amount. We know how much money is sitting in here, and we can just move that into the lira. But if we have a defined benefit plan, then we have to take what's called the commuted value. And what the commuted value is, it's basically a calculation of what that pension would be worth if you were able to take that pension today. That's a fairly complex calculation, and we typically need to get an actuary or the plan sponsor to show us what that commuted value is. Okay, I hope this helps to understand the mechanics of leaving a pension plan. There is a lot of variability here, a lot of difference from province to province, many different rules that can change, but the principles are all really the same from province to province. And what I've shown you here is what's generally tested with both the mutual funds and life license level, as well as what you're likely to see tested at the financial planning level. I hope that helps. Please let me know if you do have any questions. Thank you kindly.